Thank you for joining me on today's video. My name is Rodney Constable. I am the president and founder of Simple Market Signals at simplemarketsignals.com. Simple Market Signals helps you understand the level of risk in the stock market through our proprietary market risk signals that are emailed to you every weekend as part of our weekly stock market-based newsletter, all for less than $20 per month. Today we will be doing technical analysis on the S&P 500 for Tuesday, May 5th, 2020, and for the analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. The S&P 500 was positive at 0.9% today, and we closed at 2868.44. What we're looking at here is a one-day chart of the S&P 500 where each candlestick represents 1 minute of trading. And as you can see, we had a pretty strong day going on for most of the day. Ran into some resistance here at this 28.98 level. You can see that over here if you're looking at this on a larger screen. And it looks like this is, at least in the short term, acting as some overhead resistance. Hit that point a couple times today. And right around 3 o'clock, kind of hit some resistance right there. And then 3:15, boy, we really sold off pretty hard and had a little bit of a bounce and closed towards the lows of the session. Still a nice day, up 0.9%, but we were up quite a bit more than that up until about 3 o'clock. So we sold off really hard right at the 3:15 to about 3:45 time frame, and then had a little bit of a bounce for the last few minutes of the day, but again closed towards the lows of the session. Again, up 0.9%, closing at 2868.44. What we're looking at here is a one-year chart of the S&P 500 where each candlestick represents 1 day of trading. And we have the green line, which is the 400-day moving average, and the blue line is the 500-day moving average. Now, I never used this long of a moving average for my personal trading and investing, but I wanted to be able to show you that, yes, even though we've come up quite a bit since March 23rd, the markets are still not that strong, guys. We're still trading beneath where we closed here today. As you can see, we still closed below the 500-day and, of course, below the 400-day moving average. Now, earlier in the session, we were poking our head above the 400, but as you can see, that whole thing reversed, and we know that we closed towards the lows of the session, and again, closing it below the 400 and 500-day moving average. So I want you to understand that yes, we're off of the lows here, but when we're trading underneath the 500-day moving average, to me, that is not a bullish sign. That is a really, really long moving average, either the 4 or the 500-day moving average. But I just wanted to demonstrate that these markets are still quite fragile, and we're still, in my opinion, in a downtrend, okay? Yes, the shorter-term trend from right here is up, but this is still a downtrend. When you can't get above the 4 or 500-day moving average, that is not a super strong market, okay? And today's market action, of course, kind of backs that up. Now what we're looking at is the one-year daily chart of the IWM, which is the ETF that tracks the Russell 2000, the 2,000 small caps in the U.S. They're U.S. domiciled, U.S. listed small cap companies. And what we can see here, this is the same, same basic chart we were just looking at over here on the S&P 500, except now we're looking at the small caps. So we have the 4 and 500-day moving average, and again, the one-year daily chart. And what we can see here is over on the right, here's where we closed today on the Russell 2000, and we're way below the 4 and 500-day moving average. And even worse than that, what we can see if you look really closely, you can see that in February of this year, the 400-day moving average crossed underneath the 500-day moving average. That is not bullish at all, guys, okay? And then when we pull back, so let's pull back now and look at a 3-year chart, same exact thing. So this is the same exact chart. I've just stretched it out to a 3-year time frame, so forgive me here, the candlesticks are all squished up. But I wanted to show you that here's that 400-day moving average, the green line. The blue line is the 500, and you can see that the 400 crossed underneath the 500-day moving average back here in February, okay? And you can see that we're well beneath both the 4 and 500-day moving average. So the first takeaway on these charts is, for the small caps, is that You want to see small caps running with the large caps if you really have a healthy bullish market. You want small caps and tech to be kind of the leaders in the early part of a bull market. And so far, this rally that we've seen over the last few weeks has been large cap US, and it's been mostly tech and healthcare. So it's a very thin rally with only a few sectors really working very well, and the small caps are being left way behind. Okay, yes, they're off their lows, but they're not up and showing the same kind of relative strength that the large caps are. So that is something to really keep your eye on and something to be concerned about. The other thing I wanted to show you on this longer term chart of the Russell 2000, this 3-year chart, is this double top that we made. We peaked in 2018 and came back on the daily chart and basically challenged that area right up here, but around the 170, let's just call it 170 on the Russell 2000 ETF, the IWM, but we could never get back above that, okay? And then you can see that this thing started to weaken in January of 2018, when we know the large caps didn't roll over and peak until February 19th. So these markets, yes, we're off of the bottom here, guys, but this is not a super strong setup. You want small caps running with the large caps. You want to see these things moving together. And when we have such a thin rally like we have here in the S&P 500, it is going to be extremely difficult for this market to continue to go up, especially at this pace, if we don't get some small cap participation, okay? But when you've got the 400-day moving average underneath the 500 on the small caps and the small caps way below either one of those long-term moving averages, that again is not a really bullish sign. Now what we're looking at is a chart of 2018, and as you can see, I've annotated it here, and these are the signals from Simple Market Signals, my proprietary risk-based model. I've distilled it down to a green, yellow, and red signal, and I'll explain that here as we go, but I used 2018 because there was a lot going on in 2018. We had green, yellow, and red signals in 2018, and 2018 on a calendar year basis was actually negative in the markets. And you're going to see here over the next couple of minutes how you actually could have made money using Simple Market Signals. You could have easily made some money in 2018 where most people were negative for that year, okay? So what we can see here is the early part of 2018, we had a green signal, and you can see how the market goes up. And what I can tell you is that in working with this model now for several years, it finally came together for me in 2017. So these are the actual signals from my model in 2018. So we can see here the signal was green for the majority of January of 2018. And as you can see here, the market really only goes up when the signal is green, okay? So that's one of the takeaways. One of the things to remember is when the signal is green, that is your best risk-reward ratio for an investor, okay? And then we can see here the signal turned yellow, and you can see that it got all choppy, and it even went red through this period. Now, just to keep it simple, I just combined the yellow and reds right here to give you an idea of how this works, but we went through a yellow and red signal period here, and then it went back to green. Now, this is unusual, but it does happen. We had a really short green signal here, lasted just a couple of weeks, went back to yellow, okay? And the yellow signals are generally sideways to slightly down signals, and you can see here this signal lasted about 3 weeks. The other takeaway here is there are times when you're using any kind of a risk mitigation model, whether it's this one or something else, where if you do only invest, let's just say hypothetically you have your biggest equity exposure in the green periods. That's the way I use this thing. And then I reduce or eliminate my equity exposure during the yellow and red because I know it's going to be really hard to make money during those time frames, okay? But there's a myriad of ways to use this, and I'll tee up a video here in a couple of minutes that'll show you how, there is a ton of different applications for these signals, and that video will go into some real detail on that, and I'll tee that up here in just a second. But you can see here when the signal turned yellow, the market fell and then started to rise again. The signal went green, and again, you can see we had a nice run there where you could have made money. Okay, and after this green session here, we went yellow here, and then it went red into the close of the year on 2018. And that's generally the way this works. It goes green, then yellow, then if the sell-off is bad enough, it turns red. The red signal is by far the worst risk-reward ratio for equity investors. The green signal is the best risk-reward ratio signal for equity investors. And the yellow is kind of that in between, right? The yellow is that transition period where generally you're going sideways to maybe slightly down during a yellow period, but it's still tough to make money in a yellow period, okay? You're going to make most of your upward progress in the stock market when the signal is green, okay? And you're going to have your biggest losses, including bear markets, all happen when the signal is red. I just wanted to take the opportunity to kind of give you an idea of how this thing works. When you're a subscriber to Simple Market Signals, these are the signals you're going to get on a weekly basis. So if you want to know more about that, stay with me. I'm going to tee up some information. But in the meantime, hey, I hope you've all enjoyed this session today. I hope it's been very educational. And if you haven't already done so, please subscribe to my channel. Give me a thumbs up on this video. And for those of you who would like to learn more about Simple Market Signals, including any of you that might be financial advisors, anybody that runs your own 401k, your own 403b, of course, your IRAs, your trading accounts, I would highly encourage you to take a serious look at Simple Market Signals. I think you can see right here that it can really, really help you. And for those of you who would like to learn more, stick with me. I'm going to tee up some additional information. As part of the Simple Market Signals model, there are two powerful indicators. There's a risk-based indicator and a trend indicator. As a subscriber to Simple Market Signals, you will receive information on what the risk level is in the overall stock market, as well as what the trend direction is in the overall stock market. So this really, really helps. The way we disseminate the signals to our subscribers is via our weekly emailed newsletter. So within the newsletter, every weekend, you will receive the proprietary risk level signal on the overall U.S. stock market. You will also receive the proprietary risk level signal on all 11 major sectors of the S&P 500. You will also receive the early bird indicator, the trend direction signal on the overall U.S. stock market. You will have market and sector performance information on multiple time frames. You'll get market commentary and a weekly recap of what happened in the market. You'll have technical analysis information, fundamental analysis information, and yield curve information. There is a ton of information in this newsletter every weekend. And a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents a day. It's billed monthly on your credit card. There's no contracts. You can cancel anytime, and your first 2 weeks are free. Now let's recap what you get with your subscription to Simple Market Signals. You get the weekly emailed newsletter with all of the contents we just talked about. You will also receive special midweek updates when warranted. So if there is a major signal change or direction change, we're not going to wait until the weekend to get that information to you. We will send out a special midweek update when necessary to keep you up to date as to what's going on within the model. And the best fit for a subscriber for Simple Market Signals is somebody that has at least a 6 to 8 week time frame or longer. So if you're a long-term investor, you're going to love this. If you have at least a 6 to 8 week time frame that you focus on with your trading and investing, you're going to love this. If you're an ultra short-term 1 or 2 day trader, kind of a day trader, or somebody that trades within a week, Simple Market Signals might help you a little bit. But the reality is, the people that are going to benefit the most from a subscription to Simple Market Signals are those people that have at least a 6 to 8 week plus time frame that they're focusing on. And if you want even more information on Simple Market Signals and some of the strategies that you can use on the various signals, this is a very in-depth video that I will have linked in the description box below this video, along with a bunch of other videos that you may want to explore if you need additional information on Simple Market Signals before you subscribe. Also, keep in mind that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, that is just due to international compliance regulations. And to subscribe to Simple Market Signals, all you have to do is go out to the website that you see here, https://simplemarketsignals.com. It'll take you about 4 minutes to subscribe. It's that simple.